Hello and welcome to my YouTube channel, guys. My name is Amit, and today's topic is going to be very interesting in terms of if you wanted to stop working, right? I mean, like literally stop working, and you had enough money. Let's say you just came across some money, or in other, well, yeah, that scenario will only work if you have a lot of money. But let's look at in my scenario. I think that might be better relatable to you guys. Let's say you guys are college student, you guys have a job, right? And you're in your 20s, or you're in high school, or you have a job, right? The whole idea is you have a bunch of times before you would turn 65 and a half, 65, before you can actually retire. And if you were to design a machine, right? I'm not talking about illegally printing money, but if you were to design a system, right, that would replace you being the person needs to work, rather that machine goes and works for you, how would you design it? So in other term, if you look at nowadays on YouTube, there are a lot of self-proclaimed gurus out there, pundits, right, who will try to tell you, buy my program, buy my books, buy my this, buy my. I actually even seen a person like literally buy their course, and then in that course they're gonna teach you how to make a course, like literally. Like you couldn't get that information for free. Like there are scams where you pay in to be part of their system so you can actually take pictures with them, right? That's just kind of sad. But outside of that, right, let's look at my example, because everybody is at different point, some degrees to the left, right? Let's say I'm to the center. People might be to the left, or to be better off me, worse off me, or they are close to me, right? Let's take a standard deviation. If I were to design a system, how can I design so that I can put all my money up until, let's say, up to 65, 30 years from now, I can keep putting, and I don't have to ever worry about losing money, and I don't want to be like old and broke kind of thing. What are the things I can do? So I am reading kind of right now Tonny Robinson's book. His book name is, it's on my Audible, let me just pull it up for you guys. The book is called Tonny Robinson, Money Master the Game. Let me pull this up. So it's called So this is the book right here. I was looking on Amazon. This book right here, Tonny Robinson. It has a lot of content, amazing content. I like the book. I wasn't a big on reading books, so Audible actually works for me, honestly. I like to read about finance, more specifically, how can I avoid, or the things that the decision I can make now that would kind of lead me to not have to ever worry about money. Money is a very interesting subject, right? So let's look at, so in his book, he basically went to Ray Dalio. If you don't know who Ray Dalio is, this person, where is he? Ray Dalio. Let's see. There you go. Dalio. I'm sorry, not Dalio. Ray Dalio. He's a legend alongside with Warren Buffett. He runs a basically hedge fund that is only open to billionaire, and in the last 10 years they haven't even accepted any new client because they currently don't have any, and you need literally billions and billions of dollars to be part of his team. So he gives an advice, Dalio, I apologize, I'm butchering his name, right? The question is how someone like me, who's, right, I'm fairly educated, I am young, and how can I invest my money so that COVID-19 or Tech 2.0 that happened, or the housing bubble, right, or inflation versus deflation, what is it that, how can I, so he said all season strategy, that's what he came up with. Basically he recommends that we have about 7.5% in gold, in commodities, right, about 7.5% of our money, the monies that we are saving, 30% should be in stock, and then about 55%, right, 55 should be in bond. So out of 15% should be international intermediate US bond and 40% long-term bond. Okay, so here's his little thought process. Let's examine this. I think you guys might like this. He said bond should be about 50 and stock 50. So bond risk, like 5%. The stock risk, okay. According to Dalio, there are 4 things that moves price of asset, right? Asset being, let's say, stock market, house that you buy or house that you live in, cars, right? There's inflation. This one we are all familiar with it. Inflation, if you look at the price of goods, like let's say you go to Walmart, CVS, anywhere, one day that price of that good, that Colgate, that toothbrush that we buy, it costs $1. That was about 5 years ago. Now that's exact same toothbrush, right? Exactly your favorite brand is no longer costing that $1. It's costing you, let's say, $3 or $4, right? That's inflation. That money's value are inflating. And then there's a deflation. Deflation is like, I was very still small, but my family went through this recession, 2008, where the value itself basically decreased, so that $1 that you paid, let's say all of a sudden you're paying 80 cents to buy exact same toothbrush. So deflation. And right now, we don't know what the future holds, right? There's no way to predict that crystal balls. Are we going to have inflation or are we going to have deflation? But more or less, I think we're going to have a lot more inflation than actual deflation, honestly, the way the money market works. Rising economic growth and declining economic growth, right? These 4 things. And then he suggests his 4 season, basically that's things that corresponds to either higher than expected inflation rising the price, which we talked about, lower than expected inflation price, which means deflation, higher than expected economic growth, or lower than economic growth, right? If one goes up, the price expected economic growth goes down, right? It's basically opposite, rising higher than expected, then the falling, something has to fall. And here it shows that if it start going up, right, that means the people don't want to invest in bonds, so that goes down, treasury bills, that kind of stuff. All right, so basically here, so this got me thinking, stocks, what kind of stocks can we possibly buy that would also allow us to be early independent? What I mean is that if you combine this kind of strategy with, like, let's say FIRE movement, especially with the dividend paying stock, I believe if we were to combine all these kind of things, we would be able to retire early and get a little bit more money, or even retire on that time, but you will have a lot more money. And if you would also get, like, let's say annuity, there is a product nowadays that even people like young as me who can buy annuities for lifetime, especially the fixed one. After I retire, I can get the deferred one. So here's what my thought process is. Maybe you guys can correct me if I am wrong. right now I wake up, I go to work, and thus I earn money, right? And then I go buy stuff, right? I spend those on different stuff. What if right now I continue to work, right? This process, this continuation of waking up and working, has one flaws in it. That means that I do not know what the future holds, right? If the economy goes this way or that way, what if I don't have enough money to when I want to retire? So the way that Tonny Robinson suggests, or in his book, is buying fixed income annuities. Now this is very common amongst the people who are retiree, around 50. So like, let's say your grandma or your mother, father would turn about 60, they just go ahead and take their 401k and they give it to insurance company, and then thus they like, as long as I live, I want fixed income. So idea is they get fixed income from insurance company, long as they live. Hopefully they'll continue to get their social security, right? And they still have, let's say, a couple houses, right? Or house or some other gold, bond, saving, whatever other saving, right? They might have that. So that's kind of the how. So what I'm thinking is, why not, because it is still also available for people who are there in 20s, I can actually, it's like a same concept of like going and working for, let's say, a company that offered pension. So you can actually use that, and they would turn around and give you your lifetime. Once I retired, they would give me that in my life, however long, they would give me the money, and I can structure it in a way that I can pass along to my heir. And there is another way you could actually do your wife, but since I'm not married, so that would be later on. But that's kind of what I'm thinking. So alongside of investing in dividend paying stock, do a little bit of speculation, because I'm still young, but I don't want to do that much speculation in the market because I really don't spend that much time. However, I'm also getting into this golds, and right now I have a silver coin, so I still need to get more. I am gonna try to have basically long-term US bonds, well, the problem with the bonds are that well, yeah, that should be fine, but the only problem that I see, if the value of that country going down, and if we ever were to come out of, right now, if you buy the oil in other countries, they buy through US bill, right? US Treasury dollar bill. That's what the other countries pays a bit, but there has been effort. I've been reading in the news that they want to get rid of that. If that's no longer the case, then we might be in trouble. Then this bond really is not gonna be as good. So therefore, I still want to have backup plan, which would be my annuity, right? Even if I retire back then, if it takes 30 years to happens, and I would have my goals, commodities, right? And this one maybe I can put in real estate, right? One of the things he talks about, like in 2008, like even people who had a lot of real estate, they couldn't even get rid of it because having asset and no liquidation, nobody else wants to buy it, then that was also a problem. So that was a deflation, I believe. All right, guys, I hope you find some value on this thing. If you have not, please subscribe. Thank you very much. Have a good night.